Hey traders, it's John Fortune here with this week's weekly Forex Forecast. Hope everybody's having a nice weekend. In today's video, we're going to, as always, go through the markets with the best 4-week forwards probability scores, and also going to be looking at 2 ways to play the Canadian interest rate decision next week, either to the long side or the short side. And on top of that, I want to go through with you the one piece of news coming out next week which has the ability to reverse the S&P 500 to the downside and potentially kickstart a third wave. Okay, so quick look at the economic calendar, and starting with the BOJ meeting last week, a super important meeting. Why? Because the BOJ came out, disappointed many speculators by stating that they are going to defend the 0.5% yield curve control cap. Now, why is this important? Because last year, if you remember, as they were defending the 0.25% yield curve control cap, they were buying bonds to do it, and this devalued the yen significantly. And it was the major catalyst for not just a bearish yen, but also a bullish dollar, because as money came out of the Japanese yen, it flowed into the dollar, and it helped with that massive rally last year in the dollar. So why is this important? Well, because yes, okay, in the meantime, they increased the yield curve control cap from 0.25% to 0.5%, and that caused the yen to rally. But if they're no longer going to do that, and if they are going to defend the 0.5% yield curve control cap by buying more bonds, and they're going to have to buy a hell of a lot of them, then what you're going to see is basically we have once again that fundamental driver catalyst of a weaker yen, which very likely now could see the Japanese yen, if they are going to defend that 0.5% upper bound as they've said they have, that is a catalyst fundamentally, as I tweeted out at the time, for the yen to head back down to the lows we saw last year, and also the dollar to start to bottom out near term and start to rally back towards the highs of last year. So very important meeting, and a fundamental catalyst now which can reverse the near-term strength we've had in the yen and the near-term weakness we've had in the dollar. Okay, so coming up this week, 2 important pieces of data: the Canadian interest rate decision. We are going to be looking at 2 separate Canadian pairs for after this takes place. Why? Because beforehand, the CAD pairs are unlikely to really move much. Markets are low volatility going into these events, and then they move suddenly. And so we're not trying to predict this, we want to be reactive. So we're going to be looking at a market to the upside if we get Canadian strength, so CAD to the upside. And we're going to be looking at a market we can try and play to the downside, in other words, CAD weakness, if we get that from this interest rate decision. So looking to be reactive post interest rate decision next week on those pairs, instead of trying to get involved beforehand and perhaps being on the wrong side of a bigger move. Now, the final piece of data here to look at, very important, is the advanced GDP data. Why is this very important? Well, the Atlanta Fed is estimating this to come out at 3.5%, as you can see. And what this means is if this comes out at 3.5% or potentially even higher, you can see from the calendar that this could very well constitute an upside surprise in GDP. Now, you're maybe saying, well, John, isn't that surely bullish? Because, you know, as GDP is going up, this is good for the economy, good for stocks, etc. Yes, that is true. However, many people forget GDP is a lagging piece of data. It's backwards looking. So what does that mean? What it means is that the move over Q4 to the upside in stocks, the sell-off in the DXY, the rally in the S&P 500 has already happened. So when the print comes out next week, especially if it's a beat to the upside, you know, all that glitters isn't necessarily gold, because the money has already been made. If the market comes out and prints, say, you know, let's say you get a great 3.8% or something. Well, all that's doing next week is telling you what happened over here in Q4. So be careful of that GDP print next week, because it's likely going to come out strong. It's likely going to look great. But what you might find is, which can often happen in the markets, institutional investors who have already made their money because they predicted using leading data what GDP was going to be, they have made their money and they will be using, maybe they've exited their positions already, which is why we saw the sell-off over here, maybe they exited in this area, but they will be using retail traders, and this is what they very often do, who come in and buy stocks on a fantastic GDP print, and they take the other side of that. Why? Because this is telling you what's happening in Q4, and what is coming with GDP in Q1 could very well be this. So a worse Q1 GDP does not mean stocks are going to rally because next week we get the print from the last 3 months. What it means is we could very well see stocks move higher into GDP, fail to break the double top high, meaning this is still a wave 2, and then the market discounts the news because it starts to look ahead to Q1, which we're currently in, just started, and if Q1 is expected, as many people do expect, including myself, definitely not to be as good as Q4, you can put it that way, that is actually going to be negative for stocks. So be careful of the market potentially discounting this GDP print next week, and bear in mind, if it does that before the S&P 500 comes up and takes out the double top high, what that runs the risk of is catalyzing the next leg down in stocks. And once we break this low, what could very easily unfold to the downside here is a third wave, which many of you will know has the ability to be quite volatile, and you usually see third waves as being the strongest moves within a near-term trend. Okay, so let's have a look at the scores for the coming week, and you're going to see why I opened the video looking at the S&P 500 and the potential risk of the market discounting a strong GDP print next week, and we start to see stocks selling off and potentially breaking down into third waves. The reason I opened the video with that is because the scorecards for the coming week are actually structured for risk on setups. The US dollar as a safe haven asset and the Swiss franc as a safe haven asset selling off or underperforming is actually risk on. You know, euro franc to the upside, risk on. Euro dollar to the upside, risk on. Pound franc to the upside, risk on. Pound dollar to the upside, risk on. So I had to start with the S&P 500 and show you the GDP data coming out next week, because if you are trading risk on setups, as we're going to be looking at some next week, you have to bear in mind that could all change when we get GDP on Thursday. So you may find that these setups perform well at the beginning of next week, and then the risk off setups actually start to reverse on GDP. So I wanted to structure that in that way to give you a heads up that if you're involved in some of those markets and they work well at the beginning of the week, don't necessarily wait for all of these to go to their maximum targets as I put onto the charts for you. Next week is probably a week to take what you can out of the markets, let that GDP print come out, see where the cards fall, and then get back to it next week. So to cut a long story short here, I am favoring, at least leading up into GDP, we're going to be looking at euro and pound longs to the upside, especially versus the franc and the dollar. And I'm also going to be looking at yen pairs vis-a-vis US dollar yen and franc yen to the downside. And that is also quite good because franc yen to the downside is risk off, and US dollar yen to the downside is also risk off, because the yen is the most risk off currency. So in a risk off event, everything falls against the Japanese yen. So we have some risk on setups and some risk off setups that we're going to be looking at, but just keep in mind that GDP print and see if it gets discounted on Thursday. Okay, so a quick look at the individual currencies before moving on to these pairs for next week. Starting with the dollar, we're looking on the weekly chart here, just zooming out to get a better idea of what's going on. We are actually back to the 7-year breakout level and also the 2-year breakout level. In other words, this whole consolidation was over the course of 7 years going back, and this consolidation here to here, this kind of what looks like a second wave and then a big third wave, and this is setting up potentially for a fourth wave before a fifth wave at some point in the near future, I would imagine, based on how sharp this sell-off is. We can see that we're sitting right at this kind of key area of broken resistance, now turning support. Now, yes, we've come down and we've started to close below this for a week or two, but because of the size of this, a 7-year breakout, you know, a couple of weeks or a few weeks closing down below this is nothing but a little bit of lower time frame volatility because it's such a big breakout. So We are sitting right at this area now, and if we break up higher next week, we could actually consolidate a bit before moving higher. And that would actually fit in, based on where we're sitting now in the dollar index, with exactly the catalyst which came out of the BOJ last week, where the BOJ starts buying bonds to defend the 0.5% yield curve cap, and we start to see money flowing out of the yen because of that, and has to find a home somewhere, starts to head back into the dollar. So keep an eye out on this setup in the coming weeks and months, because we're not only at a key area of support now, but we also have that catalyst as of last week that could send the dollar higher fundamentally as well near term. Next is the euro, and again I've zoomed out here so you can see some of these breakouts that we've been talking about. And yes, we've broken back to the smaller breakout here from this high, really just looking at the inverse of the dollar. But again, this should not be considered, as it currently stands, anything other than essentially a bit of lower time frame volatility around what is otherwise quite a massive major breakout. On a monthly time frame, for an example, this weekly move, or on a 2 or 3 month time frame, could simply be a wick higher, and then you can have a candle like this if you look at it on a monthly time frame. So what you think is a bigger breakout here is not actually in proportion to the breakout itself, and this could just simply be essentially a wick on a candle on a higher time frame testing this breakout before heading lower. So when you put those two things together, what we've looked at technically in the dollar, in the euro, the fact that the BOJ has started to dig its heels in to defend, to buy bonds, to defend the upper bound now at 0.5%. And we have the GDP data coming out next week, which is likely to be strong and possibly discounted. You can see a picture start to form where you could actually see a reversal take place in the euro to the downside, in the dollar to the upside, on that GDP print next week. Now, I'm not saying that the markets are definitely going to discount the GDP print next week. However, you can certainly see a scenario where that happens, and that could kickstart the dollar higher and also potentially the euro back down below this major breakout level. Next is the pound. Now, the pound on the bigger time frame really summarizes everything I've been trying to say to you in this video, which is that next week is a week to be nimble, and it could be quite a tricky week to trade. Why? Because as it currently stands, we should be looking at some of those risk on setups, and pound long positions, especially versus the dollar, versus the franc. I do like those heading into next week. The problem is, as we've seen in the dollar, in the euro, and also in the pound, we are getting to these areas where we could see the markets reverse, and that could take place on the GDP print. So really what I'm saying to you is, if you are trading some of these risk on pairs and you get some good moves at the beginning of the week, I would avoid being greedy and taking the risk through GDP, because you could see those all reverse. And these are not necessarily markets that you want to be holding for the entire week. They're markets that you might want to be getting involved with and then out of with some profits as and when you can. That's really what I'm trying to say to you going into next week. Next is the Swiss franc, major double bottom that I've been highlighting for you in the weekly, and I did note that we're kind of just consolidating above this. I do believe the Swiss franc goes much higher this year. However, as it currently stands, we are kind of ranging. I wouldn't be surprised to come back and retest this, and especially if we're going to get a little bit of risk on early, I do think this could just continue to consolidate next week. Next is the yen. We still haven't tested the major breakout level down here in the weekly chart, and why this is important is because this is probably going to test this. So I would not be surprised to see a little bit more yen strength into this, and if the yen is going to start to roll over because of what the BOJ is doing, and we don't get a big risk off move which actually sees flows into the yen, say we just get a continuation of stocks lower, but there's no real capitulation, there's no real strong sell-off, it just kind of grinds lower as it's been doing, then this would possibly be the end of the Japanese yen run. I'd like to see it more in the scorecard data first before I got short or anything like that, but I do think there's room to see the Swiss franc lower against the yen next week as this trades into the major breakout level, and also dollar yen down, and maybe some of those other yen pairs as well. But I favor franc yen and US dollar yen to the downside against the yen, looking for the yen just to push into this and test this major breakout level perhaps next week. Next is the CAD interest rate decision next week. I would not be surprised to see this coming up and testing the 75635, as I've been saying to you in previous videos, and this is a major bear flag. and also simply a retest of the previous breakout. So let me just make that a little bit cleaner for you by taking that off and showing you. This is all we currently have in the bigger picture for the CAD. So I wouldn't be surprised to see a little bit more upside in the CAD, especially post the interest rate decision, if for whatever reason we get that. And for that reason, I would like to see US dollar CAD lower on a stronger than expected CAD after the BOC, but only really into this area here. This is where I think we could start to see this market stalling out and back down towards the previous low, and maybe in a bigger sell-off back down to this low. But look out for this near-term rally, and then post BOC next week, I would be interested to see if we're at this level and we start to roll over for the next bigger move down in the CAD. Aussie dollar, again, we're running into the same problem with the euro, the dollar, the pound, which is that this is essentially a correction. And although, you know, Aussie dollar to the upside, maybe it goes a bit higher next week, maybe this tests this area, it feels like we're starting to run out of road in some of these, and we could be due for the next leg down. Because again, as it currently stands, this is just a big bear flag with a deep correction. Here is the previous high, here's the previous high, here's the previous high. This is actually, as it currently stands, a lower high. And even if we test here, we can fail at the previous high and still get a lower low. You know, a trend change is a test of the high over here, new high, then a failure, and then a reversal like this. So kind of neutral on the Aussie at the moment, but it does look like we could be coming towards the end of the runway here. And finally, the New Zealand dollar, which we've been discussing in previous videos, a huge rally, 17% in 9 weeks, which is very, very similar, in fact, almost outperforming the 13-week 20% rally off the COVID lows. Well, when you consider this was hand in hand with massive stimulus, absolutely unbelievable, mind-boggling amounts of stimulus put into the economy after the COVID crash, this same rally, which is matching or potentially even outperforming, if you did the maths, I suppose, you could see that this is happening at a time when the Fed is raising rates. There's no massive stimulus coming in. So this move here does seem somewhat of a mispricing. The market is never wrong. I never take that opinion. Only we can be wrong as traders. But this does seem to be very, very, very overdone. And whether we start to reverse here, or if we test the previous high and start to reverse, which often happens when you get flash crashes like this, comes back and tests the previous high, I do think, again, we're running out of road here. And all of this also points to a potential bottom near term in the dollar. Okay, so let's have a look at the watch list for the coming weeks, starting with crude oil. Now, crude oil in the commodity scorecards is absolutely bang neutral. It's a 0. And what that means is I have no bias in crude oil, either to the long side or the short side. This market is actually ranging technically, and this could just as easily come down next week as it could go higher. The only reason I'm looking at this on balance just about to the upside is because crude oil was very weak in the scorecards and it started to get stronger. So the momentum in the scores is to the upside, even though it's at 0. So any pullback, if you were looking at trading this, I would only be looking for buying opportunities. And because I don't have a very strong bias on this, this may not actually come up all the way to this max target area. We may see it trading into the highs, and you can take short-term range trades on it. But any pullback, I'd be looking for buying opportunities. And if we reach the 85, 86 area, I would be out of those positions, because beyond this, the odds start to move against you if you're long. Next is pound dollar. I do like this market to the upside, but just be wary of a potential discounting on Thursday. And that could actually lead to the pound versus the dollar rallying, for example, at the beginning of the week and then reversing. But any pullback in this market is viewed next week as a potential to look for buying opportunities. I'm going to be looking up towards the 1.2550. And if we get to the 1.2550, 1.26 area, this is where I would be out of any long positions. This is the max profit taking opportunity, because once you get to this area, the odds start to move against you again if you're long, and the risk of a reversal is much greater in this area. Next is US dollar Japanese yen. I've added this in gold alongside pound franc, pound dollar, and silver as the 4 markets out of all of these that I'm most focused on next week, because not only is the dollar the weakest and the yen the strongest, but this does also look like we have a 1, 2, a stronger 3, and we're setting up for a 4th wave correction. And any pullback in this area is going to be viewed next week as an opportunity to look for shorts down towards the previous low, which sits right between the 127.50 and the 127 target area down here. Once you get beyond this, the odds again start to move against you if you're short. What I also like about this is a risk off currency. So if you get involved to the short side and something starts to really tank, in the stock market and you get risk off, this should also move lower. So you're kind of covered on that basis as well with this market. Next is euro dollar. I was looking further upside in this market last week and we did move a bit higher, but like many of the markets, it just consolidated. There was real lack of volatility. Markets didn't really move very much last week. And after periods of consolidation come periods of volatility. So I am expecting this to potentially break out. Maybe it pulls back a bit first, but any pullback is going to be viewed as a potential buying opportunity up towards the 1.0950 and the 1.1 target area over here. Next is pound franc. Now I do like pound franc because we've had this consolidation and a breakout. So any pullback is treated next week as simply a bull flag set up here. And I'm going to be looking for potential buying opportunities given the chance up towards the 1.1520 area. And again, this sits right at the previous high. So if we come up, especially if we come up and test this high, that's going to be a great place to start to book profits to avoid being involved with this as the odds start to move against you if you're long. Next is franc yen. I also quite like this market next week, and it does look like we could be coming down to the lows, maybe not next week, but any continued pullback is simply viewed as a potential opportunity to look for shorts down towards the target area of the 13850. Next is US dollar franc. Now US dollar franc was a market that I was looking for long opportunities in last week. We did sell off and we had a nice rally. I actually bought this a little bit high and I got out of it a little bit early, so I didn't capitalize on this, but that was an example of an opportunity. Although it didn't come up towards its target, there was a good opportunity to buy this a little bit lower down here. And going into next week, I am still favoring this to the upside. However, this is a risk on market. So what I'd be looking for, if we get an early week rally, again, I'd be very wary about holding this through GDP in case it gets discounted. Any pullback next week is viewed as an opportunity for those of you looking to trade it to be long once again into the 1.0080 area. Okay, so the next two markets we're looking at are CAD interest rate decision plays next week. This is after the announcement has been made, being reactive. Starting with US dollar CAD, if we get consolidation as is likely before the interest rate decision, and then we get a strengthening of the Canadian dollar and we see US dollar CAD sell off, that is going to be the opportunity to start to look for a pullback and a follow through down towards the 13250 area. And the second CAD pair here is pound CAD. I like this. We've got a big rally to the upside, nice inverse head and shoulders breakout. And I am looking further upside, but with the interest rate decision out of Canada on Wednesday, if we consolidate and in fact we see the opposite happen, we see the CAD selling off, we get a weak CAD and therefore pound CAD rallies, going to be looking for any potential pullback, and you can look for a follow through trade into the 1.680 area. Okay, so wrapping up the video with gold, silver and Bitcoin, starting with the gold silver ratio, you can see we've been correcting here and it does look like we could actually be coming down as of next week in the gold silver ratio. So for that reason, I favor silver to the upside over gold. However, I am near term bullish on both of these as the dollar sits in the scorecards at -3. But again, I can't stress enough that GDP print on Thursday could actually change things, so watch out for that on Thursday. Next is gold. Gold is consolidating slightly above a breakout above this high here. Can you see this? We broke, we retested. Going into next week, this might fail early on. Not often markets rally straight from the open. They do sometimes. But what I would like to see is, if you're not already involved with this, really any pullback would be great. And that would provide the opportunity to look for buy setups. And if we start to trade into the 1970, this would be where I would absolutely be booking max profits, because once you get past here, the odds start to turn against you on the long side. Next is silver. Silver has been in quite a long consolidation here going back to the 12th. And any pullback in silver, again this week, if we come down, test the lows down here, this would be viewed as an opportunity to look for bullish setups. And if we trade into the 24, let's say 0.90, this is going to be where I'd be booking my profits at an absolute max to avoid, again, being on the wrong side of a reversal in this market. And last but not least, we have Bitcoin. Bitcoin traded into the key area highlighted last week, and we actually broke through this. Coming into this week, I am still bullish, and any pullback in Bitcoin is viewed as an opportunity to look for buy setups. And if we come and trade into the 24.50 area, this would be where I would be booking max profits on this, again, to avoid being on the wrong end of a reversal in this market. Now, bear in mind, we traded into the target area last week. When that happens, often you need a week or so to correct. It doesn't always move from target to target to target. It can do, but don't be surprised to see this correct first and then start moving again in subsequent weeks. So that is it from me for this week, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the room each day where I go through these markets and the setups that I'm personally looking at with members on a daily basis for over 75 markets in different asset classes, including stocks, bonds, Forex, and commodities. So if you'd like to know more about the benefits of GMT membership, why not check out the link in the description below and in the pinned comment where you can get a 2-week free trial totally risk-free. So have a fantastic weekend. I'll see you all next week.